Thanks for watching this Magellan update. Today I'm speaking with Hamish Douglass, the co-founder, Chief Investment Officer and Portfolio Manager. Hamish, the Global Fund is seen as a pretty defensive strategy by many investors and their advisors, yet the fund is up 29% in the calendar year. Can you give us some insight into that?
Well, first of all, I'd say to Frank is, when the market's up very strongly, I wouldn't expect us to be outperforming the market because typically half our portfolio is set in very defensive assets, cash and defensive assets, and they tend to lag somewhat. And to outperform in a market, normally you'd be expecting the other half of the portfolio would have to dramatically outperform a market. Actually, the market's up sort of 29 and we're more than 29, or maybe they're 28 and we're 29 and something. So we've outperformed a very, very strong market this calendar year in the first 11 months. I think a significant reason why that has occurred, and as I say, I'm cautioning people not to expect that to occur, is we made a decision early this year after the Federal Reserve changed its view on monetary policy. They were tightening monetary policy and increasing interest rates. They actually signalled in December last year there'd be another few rate rises this calendar year. And in January, when the minutes came out of their meeting, they actually said they're going on pause. And shortly after that, and we had been warning people of the consequences of rising interest rates on market valuations. And through 2018, we were sitting in 20% cash, and actually the portfolio had done very well when markets were selling off. So actually we could have really been caught out then when markets started a very strong rally with 20% cash, we could have materially underperformed the market. But through some luck and good judgment, we actually changed our view when the Federal Reserve changed its view, and we went into a view that we think we're going to have much lower for longer interest rates, and we're not going to have a grinding up in sort of long-term discount rates. And that had a fundamental effect. One, we started wanting to get out of cash, and we started investing in more defensive equity assets. PepsiCo was one, Heineken was another. We bought a series of US utilities. And we actually went into a number of those investments before they really started reflecting this change of view. So our defensive portfolio for the first 6 months of this year actually performed very well. We actually made some very, very good calls. Judgment and luck, I would put that down to that. And our growth portfolio has performed very well. Interesting, in just the last few months, the portfolio has moderately underperformed this sort of last part of the market, and that's because the 50% in defensive assets, now people are expecting a trade deal. Some of those bond yields have started to go up somewhat from their super, super low levels, and some of those defensive assets, some of our staples and other things have sold off a little bit in the last few months. Am I worried about that? Not at all. In a way, it's comforting that those defensive assets are finding a level and not keeping running up, because then when you really need them to be defensive, they may not be defensive. But as I say, very pleased with how this year's gone. Actually very pleased how 2018, when we actually wanted defence, we had defence, and when you needed offence, we've actually had offence in the portfolio, and we have a defensive and offensive portfolio. But probably this first 11 months has gone better than I would expected to in a sort of rally this strong.
And Hamish, you quickly mentioned then the trade deal. Will Trump do a deal? Can you give us an update on the China-US issues?
Yeah, well, I think it's very likely in the short term we will have some form of trade deal. That is famous last words, Frank, here. I think there is a strong incentive on both sides of the equation. Certainly our intelligence is telling us from people who are very close to the trade talks that there is a very strong desire to get it across the line. I think Trump wants to prove to his base a large agricultural purchase. The agriculture sector has been doing it tough in America, and I think he has to put some runs on the board for the base that his tactics with China are good for them at the end of the day. There's one thing about getting the headlines, he's been tough on China, but if his base is suffering at the same time and before the election he has nothing to show them, I think, and this is why they're going so strong on the demonstration of the agricultural purchases. But this is a truce. This isn't a complete deal. The fundamental issues underlying it are not going to go away. And Trump's going to be making a very big issue of that, I would say. This is phase one. There are still a lot of other things he needs to sort out, and he's going to be super tough on China. And there are legitimate issues, and I think issues that will never get sorted out. I don't think China's ever going to back off the subsidisation and sponsorship of its state-owned enterprises. It's absolutely core to their economic model. Are they going to give up their Made in 2025 ambitions in the technology spaces? I think that is very unlikely to occur as well. Will they do things on intellectual property? Will they do things of opening up some markets? Will they do things in agricultural purchases, which will take some heat out of these discussions? Yes, I think. And I think we'll see elements of that in a trade deal. But we got close to a trade deal last time, and the Chinese withdrew and redacted a lot of agreed text. Our read at the moment is both sides want to get something done, stage one done. Here, China is slowing down. I think it wants to take some heat off. I think Trump wants to show politically some benefits to part of the base here. But he'll come out very strongly. This is the greatest deal that's ever been done, but it's not over, and I'm still going to be tough on China. And the reality is that the strategic issues, I'd put there's three issues with China here. One is trade. The second one I would say is geopolitical. And geopolitical is about the South China Sea. It's about the Belt and Road Initiative of China expanding their influence through the rest of Asia and into Europe. And then, of course, it's technology supremacy here. There's an arms race going on in technology supremacy. These issues are not going to disappear in a year or 2 years or even 5 or 10 years. They're going to be ongoing issues. Are we going to see a further decoupling of these economies? I think in some strategic areas, yes, but will economically they start to decouple? That would be very worrying economically for the long-term health of the world if it's a full economic decoupling. But if it's a strategic security in very select areas of decoupling, I think the world can deal with that, but there's going to be tension. So a trade deal the markets will like, but don't think this is the last we're going to hear of this, nor the volatility that will be associated with the China-US situation. And it will extend beyond a Trump presidency as well.
And so, Hamish, what does worry you most at the moment?
The thing that really worries me most from an investment and markets point of view is that the markets and the central banks in the world are actually wrong about inflation. We've had very low inflation since the GFC around the world. We've now had central banks cutting interest rates at the end of a cycle. We've still got quantitative easing in Europe and in Japan at the moment. We're in this super low interest rate world that is being reflected in markets. If we suddenly got some real inflationary pressures, particularly in the United States, this setting that the central banks have is incorrect. And if the markets now would expect to reverse this setting and start to increase interest rates, it's hold on to your chairs. And it's very, very hard to defend against in an equity sense as equities becoming more and more pricing, and particularly defensive equities, which we would normally want to protect us if their valuations would get repriced downwards if bond rates were to jump. I put a much lower probability on that event today than I put 12 months ago on that. I was very worried about that 12 months ago, and that's why we're in 20% cash, but we're now in 6% cash or so. So we've got much less cash. It's obviously been beneficial because we have to keep up with this very strong market recovery in changing our cash position. But it is probably the number one thing I think about in portfolio construction and how we deal with that risk and how our portfolio could deal with that risk, even though the probabilities are going down. So that is the canary in the coal mine that will kill this economic party if it was to occur. But I think we have to talk about it would have to be a significant inflation shock. Mildly increasing inflation. I think the central banks have already said we're going to be we're going to accommodate that. We're not going to suddenly change course just because wages go up slightly faster, or we see inflation at 2% or something, core inflation in the United States at 2%. I think if it ran 2.5% to 3%, that's when everything would start changing.
And Hamish, at a recent conference, you mentioned that you're looking at gold as a potential proxy for cash. Can you kind of update us on that line of thinking?
Well, it actually comes to the previous question you asked, Frank. You know, what is the one thing I worried about? And the one thing I worry about is that inflation comes and some of our defensive assets won't be as defensive. So the one thing I'm asking is, what are the characteristics of gold? It really is an alternative to currency. So I would view it as an alternative to my holding of my US dollar cash. And gold typically goes up when markets panic. So it's got an inverse correlation to market. So if we got an inflation shock in the world, gold is probably going to do pretty well. Probably one of the few sort of assets that would do well in that environment. So could gold form part of a portfolio that, instead of just holding cash, could you hold a gold ETF as part of your cash holding? I do not view gold as a stock, as an investment, like an investment in Google or something. You know, it doesn't have any cash flow. You can't calculate its intrinsic value, but neither can you calculate the intrinsic value of the US dollar. It's a currency. So is gold an alternative to our US dollar currency? It is a question. And is it appropriate question in this environment that's incredibly complex, that defensive equities, if bond rates were shooting up, may shoot down? So could you find something that would go up if we got an inflation spike in the world? It's only in a question. It's a very interesting question that I'm asking of our macroeconomics team at the moment. I have not made a decision that we're about to invest in a gold ETF, but I'm always trying to challenge our thinking and what is the optimal portfolio construction in the environment that we're in. But we would never buy a gold miner or a commodity miner. It's only a currency I'm thinking of. And in the longer term, which is a longer term question, with all the money and the government debt in the world and the money that's been printed, ultimately will they have to devalue effectively currencies, and therefore is a real asset like gold a better currency investment than the US dollar? That's a longer term question, but gold is volatile. Currencies aren't volatile. Gold is very volatile in that. So what is the volatility risk you pick up as opposed to that? So I don't want to say people should rush out and buy gold ETFs as a way of helping hedge their portfolios. I haven't reached a concluded view, but just giving you some colour of why I'm asking the question.
And Hamish, you recently made a comment that it's risky to not invest in China over the next 10 or 20 years. Can you elaborate on that thinking?
Yeah, well, China's the second largest economy in the world, and if you have a look at what's happening in their consumption class of their consumers, and you look at the income pyramid, we think there is a very powerful structural force at work. As you continue to urbanise the Chinese population, they're urbanised at maybe 55% of the population is in urban areas. So we've still got a long way to get to sort of 75 to 80% of the population that's ultimately going to be urbanised. You're probably urbanising 30 million people a year at the moment. As you urbanise, you keep driving the income effect and the middle class effect, and the middle class effect actually drives an affluent effect, and an affluent effect drives the ultra wealthy effect. And if you look at the income period at the moment, if you take the millionaires in China, there may be about 10 million of them at the moment. That's growing at about 20% per annum in terms of the number of millionaires. So if you want to get into luxury goods, the place where all the luxury good growth is really coming from is the Chinese luxury consumer. If you go to the affluent level, people maybe with $50,000 or $60,000 of US dollars of income and above, there may be 50 million people in that. You know, it's growing at around 15% per annum in our view, maybe for the next 10 years. But if you just look at the total middle class consumption class, it's growing at 7 or 8% per annum. In a world where you have isn't growing, Europe's not growing, the US is slowing down, Australia's slowing down, yet the consumption class is growing maybe at 7 to 20% per annum in China. where else in the world are you getting exposed on scale to those sort of growth rates maybe over the next decade? Of course, there's risk. It's a country that's opaque. It's got a relatively closed capital account. It's got an authoritarian government in power. But political risk exists all over the world. We just may be more comfortable with political risk in America, but if you're following the elections in America at the moment, some of the Democratic candidates, people think Trump's scary. Some of the Democratic candidates are truly scary in terms of the economic policies. If you look at the UK at the moment, we're either going to have a Brexit or we're going to have communism in the UK. So I would argue to some respects the political risk in China is more predictable, even though it's more foreign to us. But I'm not trying to underplay it. There is political risk in China as well. But I think China is going to throw up more scale investment opportunity over the next 10 to 20 years than virtually any other place on the planet. And just because you don't understand the system and you think there's political risk, to not be there at all, I think is a very risky position to take in a world where growth is going to be very hard to come by.
So Hamish, we're fast approaching firm-wide funds under management of $100 billion. Has that caused you to reflect over the last 12 years? And what are you thinking over the next 12 years?
Well, Frank, as you know, the first thing we don't do at Magellan is get carried away with success. And I think that is a huge mistake that companies make. I think it's very important that we continue a day one mentality all the time at Magellan. There are very few investment management firms that ever succeed the test of time at the end of the day. They all enter stasis and then decay. If we get carried away with ourselves because we've got 100 billion of funds under management and think that we're kings of the mountain or anything, we're going to hit stasis and ultimately decline at Magellan. We have to have that incredible humility and humbleness. We have to keep serving the client, and we have to keep moving forward, and we have to keep solving client problems and innovating, and as I say, do it with a huge amount of humility. We have to treat where we are today like where we were 10 years ago. And I think if anyone really knows our culture, that's what Magellan is about. There is very little, I don't want to say it, you won't like it, very little bullshit in this place. And I just firmly believe in that. So what can we do in 12 years? I hope that we haven't hit a point of stasis in this organisation. I hope the organisation is, in a way, less dependent upon me. My ultimate challenge is to make myself redundant. I'm not about to retire. And I would even say in 12 years' time, I'm not about to retire either, but we have wonderful people coming through the organisation. We're going to innovate with things. Next year we're probably going to be launching the retirement product. I think we're solving a massive client problem. There will be other retirement product type solutions over 12 years. Do I know what they are today? No, I don't. We don't have some grand plan for this. But, 8 years ago, we didn't have a grand plan about the ETF market either, the active ETFs. But 3 years ago, we delivered really Australia's first active ETF, and that has been a wonderful outcome for clients. I think you'll see Magellan do more things that truly innovate and solve clients that other fund managers can do as well. And by continuous innovation and a day one mentality, I think we may avoid some of the traps that most fund management firms go down, and then ultimately the firm will be, in 12 years' time, I think look slightly differently. We'll still do in core infrastructure, core global equities. Hopefully we'll have a meaningful retirement product. There'll be some other things that happen which we haven't thought of yet at Magellan, because we have that day one mentality of how do we keep innovating, how do we think, but we only want to do things that truly solve client problems. And then, if I went to 20 years or 30 years, I hope I've made myself redundant at the end of the day. But we've got a thriving organisation with still humility and a day one mentality at the end of the day. It's very, very hard to do. Frank, but I look around the office and I even look at you, we still all skip to work every day, we're still having fun, and there's no bullshit here. and that's what we're about at the end of the day. But as I say, is there a grand plan for the next 12 years? No, there's not. But we'll have a lot of fun doing what comes our way.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching this Magellan update. As always, feel free to forward the link on to colleagues or clients where you think it may be appropriate. Thanks.